Thanks to our friends at The Motley Fool for sponsoring this video. Check out the link below, fool.com/the smattering, to get access to the 10 best stocks to buy right now. It's not very often that you can combine the term utility and growth stock together, but that's certainly been the case for NextEra Energy. Over the past decade, it has generated over 280% in total returns for investors. That's a 16% annualized rate of return, far better than the average for the S&P 500. I'm Jason Hall. This is The Smattering. I've got Tyler Crow here with me, and we want to talk about one number, a metric with NextEra Energy that indicates its best days might be over. Hey, Tyler.
Sometimes it's just healthy to look at the bad things in any investment, no matter how good it's been.
Well, I don't even think necessarily the bad things, because the reality is that you always, as an investor, not sometimes, always want to find the things that challenge your bull case, because I promise you, you will always be able to find a way to convince yourself that you're going to be right about something. It's a lot harder to figure out the things that you miss and that you're going to be wrong about if you're not specifically looking for it. And I think that that's the case with NextEra Energy right now. And it's worth at least exploring what our concerns are. But first, Tyler, let's take a look at NextEra Energy, the great things that could still continue to be good for investors going forward, before we get to kind of that caution thing that's at least worth understanding.
Part of the reason that NextEra Energy has had this fantastic returns for quite some time is it married two ideas. It's a regulated utility with much of its business in the state of Florida. So you have a higher than average GDP growth, higher than average population growth. And so you have a regulated utility that's growing faster than most regulated utilities in the United States. Now, where NextEra really starts to differ itself from a lot of other utilities as well is it has a very significant unregulated power generating business. This is things that it just sells to commercial clients, sells to other regulated utilities, kind of fills in the gaps for companies that don't have enough power. Specifically in this non-regulated business is renewable power growth. A lot of wind power, a lot of solar power. It's a place that it has plowed a lot of money in, and it's been a great opportunity for growth. On top of its spectacular total returns growth, it's had above average dividend growth. So it's been very popular among investors. The one challenge, though, is when you have an unregulated segment, you're not beholden to debt to capital issues. And that's where NextEra Energy, again, is unique. It has this limited partnership called NextEra Energy Partners, where it has been kind of selling projects that it invests in. Once they're fully developed, it sells them to the partnership, which just owns them, runs them, throws off a big dividend and a transactional vehicle to give investors more direct ownership of power generating assets rather than the utility itself. It's been a great partnership so far, but this is where we start to head into where things could start to become an issue.
The very nature of the structure of utilities, right? You talked about these two parts of the business, the regulated utility and the non-regulated utility. And the reality is that they've been able to build them both because they've taken on tremendous amounts of debt to build power production assets, whether it's natural gas facilities, whether it's renewable wind and solar resources. It's not cheap to do it. You spend billions of dollars. Typically, you do that through debt, and generally you don't actually pay it off. You service it, you pay the interest, and then you refinance that debt. Let's talk about, this is the number, right? This is the key thing that has increased. This is that metric, and that's the debt to EBITDA. We're just going to start with that, right?
Yeah. So this has happened at both levels, and I think one has caused the other. I want to start specifically down at that partnership level. That transactional kind of relationship that it has with the parent NextEra Energy is kind of predicated on NextEra Energy Partners being a cheap source of capital. And you access cheap debt by being pretty creditworthy. Well, as of recently, its debt to EBITDA at the partnership level has been scaling upwards. As much as 5 years ago, in 2018, we were looking at a debt to EBITDA ratio 5.8 to 6.2 in 2018. Today, as of the most recent quarter, it was 8.6 annualized. It's at 7. So it gives you an idea that things have been deteriorating in terms of total debt. At the same time, Equities got more expensive. This was a company that, or the partnership typically, paid a dividend somewhere in the 4% range. That has now ticked up into the high fives and is getting close to 6. Your cost of capital is higher. And it's starting to have a knock-on effect with the parent utility as well. If we look at NextEra Energy's debt to EBITDA, same thing. 5 years ago, it had a debt to EBITDA of 4 times. And for the last 12 months, that has trended all the way up to 5.8 times. And so we've seen a significant increase in the leverage at both the underlying partnership and the parent utility. Now, this isn't some giant fire alarm bell that says people should run away from NextEra Energy.
I think we could still make the argument this is, if it's not the best run utility in the US, it's one of the best operators. And it also still benefits from those same tailwinds that we talked about. The Florida's still growing its economy quickly, and that's a tailwind. And we know that we're going to continue to see more wind and more solar continue to be deployed. That's also a tailwind. But it's what's happening to the balance sheet, taking on more debt, particularly when you combine that with this new interest rate regime that we're in, that it's simply going to cost more, not just to add debt, but also to refinance that existing debt that's on its balance sheet already.
Which means when you're making new capital allocation decisions, you have to meet higher rates of return. And when you have higher rates of return, that means you're probably more selective. You have to pick the cream of the crop sort of investments that you can make. It just means there's going to be fewer out there. And so when you combine these things together, it would suggest that perhaps the dividend growth, the overall growth that we've seen, this higher than normal growth for utilities, is starting to show some signs of strain.